Michael, welcome. And are they going to be able to keep up with, rates and inflation this year?
Yeah, that's a great question. I think dividends are critical for investors to be focusing on in 2022. A lot of people are probably familiar with the fact that over the long term, dividends have been responsible for about 40% of the total return in the S&P 500. But obviously, in the last few years, where capital appreciation has been so strong, dividends have been less relevant. As we move into 2022, I think given sort of more restrained expectations for capital appreciation, it seems like dividends will be responsible for more of the gains. And as you pointed out, it's absolutely critical to have growing cash flows and earnings in the face of inflation and rising interest rates. So we think for both those reasons, with lower expectations for capital appreciation and with rising rates and inflation, it's absolutely critical that investors look to dividend growers.
Yeah, and there's a lot of different funds and ETFs that try to basket these together. What would you say to those who are looking for a basket approach versus going with individual names?
Yeah, I think I think diversification is proven to be, I think, the only free lunch in finance and economics. So it's critical to be diversified. Of course, I don't think you need to necessarily be in 50 names. You can find diversification in much less than that. But as you're thinking about where to allocate your monies and what to look for, there's a couple principles that we think are relevant today with inflation and thinking about dividend growth. The first would be, broadly speaking, it's important to find companies with pricing power. Companies are seeing their costs go up, whether it's their wages or their raw material inputs. And it's important to find companies that will be able to raise prices sufficiently to offset those rising costs. Thematically, if you drop down a little bit, a couple sectors stand out as being well positioned for this environment. So financials, like banks, are actually levered to increasing interest rates. So as rates go up, they'll see their earnings accelerate. Similarly, energy companies who produce oil and gas will see their earnings go up a lot as oil prices are higher. The last thing I think that's important to consider as you're thinking about this, or one other thing that's important to consider, is what to avoid and what to be careful about. And I think while no one big statement is true, we're concerned about high multiple stocks broadly. After the last few years of very low interest rate environments, we've seen multiples on assets broadly increase dramatically to really all-time highs. And as interest rates rise, there's a real risk that even great companies will see their multiples compress just because of the burden of being compared against higher interest rates.
So let's get to a couple of names you like that fit the bill.
Yeah, sounds good. So one of the names we really like is a company called Enbridge. They are one of the largest oil and gas pipeline companies in North America. It yields 6%, which is pretty staggering in a low-rate environment like this. The dividend is well covered, and we expect it to grow in the mid-single digits. People are worried about inflation, and importantly, over half of Enbridge's revenues have built-in inflation escalators in the contracts. So if inflation does turn out to be a bigger problem, they'll be able to pass it along. Lastly, while it's predominantly a traditional energy company and it's mostly oil and gas, they're actually a sizable player in renewables. And so over time, as they continue to pay out a good dividend, they're also retaining some of the cash flow they have to invest in growing their renewables platform. So over time, the mix should improve and support the energy transition.
And I see two others you like are Comcast and Apollo. Comcast, of course, owns CNBC and NBC Universal.
Yeah. So Comcast, as I probably you guys know, and I don't have to tell you guys, the stock got hit in the fourth quarter of 2021, and it came under pressure because of concerns about competition. And we think the pressure's overdone. Today, Comcast shares traded about 14 times earnings, which is a significant discount to the market. And Comcast's biggest earning driver is its cable systems business, predominantly high-speed data. That business is still growing, both in terms of subscribers and also the ability to raise prices. So we see solid growth in that ahead. And you combine that with a cyclical kicker, which is as the world continues to heal post-COVID or as we exit from COVID, the park should continue to see increased attendance and earnings. So at 14 times with a strong core in the cable systems business and a cyclical kicker in the parks, we think Comcast is very well positioned.